Bitcoin is no stranger to volatility. If you've been in this market long enough, you already know one truth. Bitcoin never moves in a straight line. But what we've seen recently has left many investors confused, frustrated, and asking the same question. Is this crash the beginning of something worse, or the setup for the next major move up? To answer that, we need to strip away the hype, the fear, and the emotional noise, and focus on facts, data, and market structure. Over the past weeks, Bitcoin experienced a sharp correction after failing to hold its previous highs. Prices dropped aggressively, liquidating billions of dollars in leveraged positions. Social media quickly labeled it a market crash. Headlines turned bearish, and retail investors once again started questioning whether Bitcoin is finished. But here's the key point most people miss. A price drop does not automatically mean the trend is broken. Let's start with the fundamentals behind the move. 1. Over-leveraged market conditions. Before the drop, Bitcoin was trading in an environment filled with excessive leverage. Funding rates were elevated, long positions were overcrowded, and sentiment had shifted toward unrealistic expectations of non-stop upside. When markets become this one-sided, even a small catalyst can trigger a cascade of liquidations. That's exactly what happened. As price dipped below key support levels, forced selling accelerated the decline. This wasn't panic selling by long-term holders. It was mechanical selling driven by leverage. 2. Macro pressure from the United States economy. Bitcoin does not trade in isolation, especially now. U.S. interest rate expectations, Federal Reserve policy, inflation data, and labor market numbers all play a significant role in risk assets, including crypto. When bond yields rise or when markets start pricing in tighter financial conditions, speculative assets often pull back. Recently, uncertainty around future rate cuts and mixed economic data created hesitation across equities and crypto alike. Bitcoin simply reacted as part of the broader risk environment. 3. ETF flows and institutional behavior. One of the biggest changes in Bitcoin's market structure over the past year has been institutional involvement through spot Bitcoin ETFs. ETF inflows and outflows now have real influence on short-term price action. When inflows slow down or temporarily reverse, Bitcoin feels the pressure. This doesn't mean institutions are abandoning Bitcoin. It means they are managing exposure, taking profits, and reallocating capital based on broader market conditions. This is normal behavior in mature financial markets. This is where analysis matters. From a technical and structural perspective, Bitcoin's recent move fits the definition of a correction within a larger trend, not a full trend reversal. Historically, Bitcoin has repeatedly pulled back 20–30% during bull market phases, even during its strongest cycles. These pullbacks serve a purpose. They reset leverage. They shake out weak hands. They rebuild liquidity for the next move. What feels like a crash to short-term traders often looks like consolidation to long-term investors. Bitcoin is currently trading near critical support zones that previously acted as resistance. In technical analysis, this is known as role reversal, where old resistance becomes new support. As long as price holds above major structural levels on higher time frames, the broader bullish thesis remains intact. A true trend breakdown would require sustained trading below these levels, not just short-term wicks or emotional sell-offs. Right now, the market is in evaluation mode. One of the most dangerous moments in any financial market is when fear peaks but fundamentals remain unchanged. Retail investors tend to sell after the damage is done. Institutions, on the other hand, use these moments to assess risk to reward. They don't chase green candles. They analyze weakness. This doesn't mean price will immediately go up. It means the market is transitioning from emotion to logic. At this stage, Bitcoin is cooling off after excessive speculation, absorbing selling pressure, waiting for confirmation from macro data and liquidity conditions. This phase is uncomfortable, and that's exactly why it matters. Markets don't reward comfort. They reward patience, discipline, and understanding. Bitcoin's next major move will not be decided by YouTube, predictions, or social media hype. It will be decided by liquidity returning to risk assets, stability in macroeconomic signals, confirmation that buyers are willing to defend key levels. Whether Bitcoin moves higher or spends more time consolidating, one thing is clear. This crash was not random, and it was not meaningless. It was part of the process. Now that we understand why Bitcoin corrected, the more important question becomes, what happens next? This is where most investors make a critical mistake. They either assume the market must immediately bounce, or they assume the worst is yet to come. Professional investors do neither. Instead, they wait for confirmation, and they track a very specific set of signals. Let's break down what actually matters right now. One of the biggest shifts in Bitcoin over the past few years is how it trades relative to traditional markets. Bitcoin today behaves less like a fringe experiment and more like a macro-sensitive risk asset. That means liquidity conditions, interest rates, and institutional capital flows now play a larger role than ever before. When liquidity expands, Bitcoin thrives. When liquidity contracts, Bitcoin struggles. So the real question is not, will Bitcoin go up? The real question is, when will conditions allow risk assets to move higher again? Liquidity is the fuel behind every major Bitcoin rally. At the moment, global liquidity conditions are mixed. While inflation has cooled compared to previous years, financial conditions remain relatively tight. Central banks, especially the U.S. Federal Reserve, are cautious about easing too quickly. Professional investors are watching U.S. dollar strength, Treasury yields, credit market stress, signals of future rate cuts. Bitcoin doesn't need immediate rate cuts to move higher, but it does need clarity. Markets hate uncertainty more than bad news. Once liquidity expectations stabilize, Bitcoin tends to front-run that shift. Short-term price action can be misleading. That's why professionals rely heavily on on-chain metrics. Here's what the data suggests right now. Long-term holders are not distributing aggressively. Exchange balances remain relatively low. Selling pressure is coming primarily from short-term participants. This matters because historically, major market tops occur when long-term holders start exiting en masse. That behavior is not happening at scale right now. Corrections driven by short-term holders tend to be temporary, not structural. Spot Bitcoin ETFs have introduced a powerful new layer of demand, but also a new source of volatility. ETF inflows tend to surge during strong momentum and slow during periods of uncertainty. That does not mean institutional interest disappears. It means institutions are timing entries, managing risk, and responding to macro conditions. Importantly, ETF demand has not collapsed. Flows are fluctuating, not reversing permanently. Bitcoin now reacts faster to macro headlines than before. This creates short-term noise, but long-term structural demand remains intact from a technical perspective. Bitcoin is currently in a range-bound consolidation after its correction. This phase serves two purposes. It allows buyers and sellers to reach equilibrium. It rebuilds volume and liquidity. Markets rarely move from correction straight into a parabolic rally. They consolidate first. Key characteristics professionals look for: higher time frame support holding, decreasing sell volume, volatility compression. When volatility compresses after a sharp move, it often precedes a large directional breakout. The direction of that breakout depends on confirmation, not hope. Retail investors often obsess over finding the perfect bottom. Institutions don't. Instead, they focus on risk to reward. They scale into positions when downside risk is limited and upside potential outweighs it. This means they may miss the absolute bottom, but they reduce the chance of catastrophic loss. Bitcoin doesn't reward perfection. It rewards consistency and discipline. Yes, and that's an honest answer. Markets do not move in straight lines. Even healthy structures experience further downside tests. A brief dip below current levels would not automatically invalidate the broader thesis. What would matter is follow-through. Does selling accelerate? Do buyers step in aggressively? Does structure break on higher time frames? So far, the data suggests controlled risk, not panic. This stage of the market is uncomfortable because it sits between extremes. We are no longer euphoric, but we are not in despair either. These are the moments when media narratives turn conflicting. Social sentiment becomes divided. Emotional traders get chopped up. Ironically, this is often when the best long-term opportunities begin forming. Instead of chasing headlines, experienced investors are reducing emotional exposure, tracking macro confirmation, preparing for volatility, not predicting outcomes. They understand that Bitcoin doesn't move on opinions. It moves on liquidity, structure, and behavior. Bitcoin's recent correction did not destroy its long-term thesis. It tested conviction. Every major cycle in Bitcoin's history included moments where confidence collapsed, right before the next expansion phase began. That doesn't guarantee immediate upside. It means the process is unfolding as it always has. At this point, the noise around Bitcoin is loud. Predictions are extreme. Some are calling for new all-time highs, while others warn of deeper collapse. But markets don't move on opinions. They move on confirmation. So let's focus on the most important question. When could Bitcoin realistically move higher again? The honest answer is not based on dates. It's based on conditions. Bitcoin does not move up simply because it feels cheap. It moves when multiple forces align. Historically, strong Bitcoin uptrends begin when liquidity conditions stabilize or improve, selling pressure exhausts. Confidence returns gradually, not explosively. Right now, Bitcoin is in the middle of that process, not at the end of it. That distinction matters. Professional investors are watching for a specific checklist of confirmation signals. 1. Stability in U.S. macro data. Bitcoin doesn't need perfect economic conditions, but it needs predictability. When inflation data, interest rate expectations, and labor market reports stop surprising the market, risk assets gain breathing room. Even neutral data can be bullish if uncertainty declines. Markets don't rally on good news alone. They rally when fear of the unknown fades. 2. Consistent ETF inflows. Short bursts of ETF inflows are not enough. What matters is consistency. When institutional money begins flowing into spot, Bitcoin ETFs week after week, but even in small amounts, it signals renewed confidence. That capital tends to be patient, not reactive. This type of demand doesn't chase tops. It builds foundations. 3. Price acceptance above key levels. A real breakout isn't a single candle. It's acceptance. Professionals look for price holding above former resistance, pullbacks that attract buyers, decreasing volatility during consolidation. Once Bitcoin proves it can stay above key zones, sideline capital begins to re-enter. That's how trends restart, quietly at first. One of the biggest misconceptions is that Bitcoin rebounds violently immediately after fear peaks. In reality, major rallies usually begin during boredom, not panic. Price moves sideways, volume fades, attention shifts elsewhere. That's when accumulation happens, not when headlines scream opportunity. If Bitcoin feels dead, that's often when risk to reward improves. For American investors especially, Bitcoin now sits at the intersection of traditional finance, regulatory clarity, institutional adoption. This makes patience more important than ever. Instead of asking, how fast can Bitcoin go up? The better question is, how much downside risk remains compared to long-term upside? That mindset separates speculation from strategy. Just as important as what to do is what not to do. Experienced investors avoid over-leveraging during uncertainty, emotional reactions to daily price swings, blindly following social media predictions. Bitcoin doesn't reward impatience. It punishes it. The biggest mistake retail investors make is assuming direction matters more than risk control. In reality, you can be right on direction and still lose money. You can be wrong short-term and still win long-term. Position sizing, time horizon, and discipline matter more than predictions. This is especially true in a market transitioning from correction to consolidation despite the recent crash. Bitcoin's core fundamentals remain intact. Fixed supply, growing institutional access, increasing integration into financial systems. Corrections don't destroy these fundamentals. They test belief in them. Every major Bitcoin cycle included moments where conviction was shaken, right before expansion resumed. Anyone can get excited during a rally. Few can stay rational during uncertainty. This phase determines who builds strong positions, who exits emotionally, who chases later at worse prices. Markets reward those who prepare quietly, not those who react loudly. Bitcoin does not need to prove itself anymore. It needs to digest. Whether price moves higher in weeks or months, the roadmap is clear. Consolidation before continuation. Confirmation before expansion. Discipline before reward. The next major move will not surprise those paying attention. Only those distracted by noise. Bitcoin's recent crash was not the end of the story. It was a chapter, a necessary one, for investors willing to step back, analyze data, and manage risk. This period offers clarity, not chaos. The question is no longer whether Bitcoin will survive volatility. The real question is, will investors survive their own emotions long enough to benefit from it?